Good morning. This is the Successful Funding Show, and my name is Karl Dakin, and I'm here to talk with you today about funding. And with me is my guest, Stephen Schaff, who I'm working with on a project to invest in communities. And for those of you who have never looked at the concept of investing in a community or raising money for an investment in a community, you will immediately find that it's a little bit more complex than a singular investment into a piece of property or into a business. And so, because of that, it's a little more challenging. It takes a little more work. And I've invited Steve to join me in a conversation about, well, how do you go about creating a crystal clear picture of what it means to invest into a community? How do you communicate that? And what goes into this whole challenge? So with that, before we get started, is welcome to the audience, those who are listening in this morning. You may enter a comment or a question in the chat room. Hopefully, you can get on board without any issues. But we'll go ahead and get started with the conversation. And if you don't happen to be with us live this morning, you can always watch this program recorded at a later point in time on LinkedIn, Facebook, or YouTube. So, with that, Steve, good morning.
Good morning. Good morning. How are you doing today? This post Labor Day Tuesday.
Yeah. Well, I got a lot of stuff done over Labor Day. I called it a 4-day work week, and I was working on so many different things, from a charity fundraiser to a book, a fundraising kit that I'm doing for charities that I'm using as a perk or reward for those who support my current charity fundraiser. And but at the same time, I got a lot of yard works done. So I cut 2 trees down, planted a tree, those kinds of things. So very busy weekend. So I'm almost happy to get back to regular work here this week and see how this goes for this short work week. So how was your weekend, Steve?
Likewise, it was kind of a break. Everyone's out doing their barbecues and whatnot, but it gave me a chance to kind of sort out all the things we worked on over the summer and then also get ready to tee off for some really compelling possibilities that we're working on for the next who knows how long. But I think it's going to be a very productive fall, and we're going to have some traction on some of the things we've been working on. Some of which we'll
Very
talk
good.
about today.
Yeah. So we're working together on a company called a project, about to become a company called RCI Community Funds. And the idea is to create a series of dedicated investment funds for different communities to help them rebuild and turn around their local economic situation. And this is going to be through a placement, raising funding, and then placement of that money into a combination of real estate and local businesses. So it's kind of there we go with the internet. We switch positions, and now I'm smarter because I'm sitting in Steve's chair. But it's a combination of a real estate and investment in local businesses, which means it's not a singular investment. And at the same time, the goal is to energize the community, to give it some economic traction. So it's going to be a group of investments done collectively towards the goal of rebuilding. And therefore, it's a little fuzzier at this point than most people would like to talk about if they're going to make an investment. So we're trying to figure out, how do we go about making the vision sharper? How do we call attention to something and explain that? And Steve and I have been puzzling through this for the last few weeks, and we're getting closer, we think, to making a picture that's vivid enough that we can communicate it effectively to other people. So Steve, tell everybody about what you're doing to make this sharper, why you think that's going to help investors, and we're using a broad term here, we'll come back to that, investors get behind this.
Well, I started out in the real estate world wanting to invest and change communities that I was living in, which were underserved communities here in Washington, D.C. And I've quickly found out that it wasn't as simple as just buying real estate and investing, getting it, folks to put up funding for a project. Working in the communities with the goals that we had was much more complicated. So when you're trying to raise capital for, say, a worthy investment project in maybe a neighborhood that's not quite ready for prime time, really adds a lot of complications. So that requires a lot more explanation of why you're even bothering talking to me about investing in a neighborhood that has a lot of issues that make me feel uncomfortable. So that's kind of one of our challenges now is we're working in a number of underserved communities that have a lot of potential. And the first thing you need to do is determine yourself, does this deal make sense, period? And what is it in this neighborhood that gives us the reason, any kind of understanding that there is going to be unhidden value, the diamond in a rough kind of concept. And that's then where your packaging and your information you're going to give to prospective collaborators, not just investors, but others that can help make this deal work. That becomes a real art and a skill because you really have to explain why you would want to invest in something that's maybe a little bit unconventional. And investors are pretty conservative. They want to invest in things that they understand and know.
Right. So we're talking about neighborhoods which are officially described, or which,
You like that?
um, yeah, um, they're called underserved according to the census or some other label, which is a recognition that the income in that neighborhood is below average, that there are a number of indicators or hard factors that says they're struggling, and as a consequence, they're behind the rest of the population. And as you put it, Steve, why would you invest in something that looks like it's in trouble or it's bad value or some other such thing? And yet we know that people do invest. The whole term gentrification has to do with what is a common practice. Real estate developers come into an underserved community, they find cheap property, they buy it, and they either retrofit it or they scrape and rebuild, and they put in more expensive properties than were there before. Or they charge a higher price for the retrofitted property. So we know that they come in and invest, so that there's already some precedence that this is a potential investment opportunity, but we're not talking about doing it that way.
No, we prefer the more challenging process. Well, when you try to attract investors, they're going to be attracted to what's already hot. So my perspective always was, aside from the social agenda that I had as an activist, why invest in a neighborhood that's already hot? You're investing at the top of the market. So, but that's quick and easy. It's pretty conventional. Your advisors know that neighborhood, and there's some evidence that you can make some money there. Uh, when you look at a neighborhood and imagine what it's going to be like 20 years down the line, then to attract capital to a community that there is no market yet because the place is not desirable, that's where the challenge comes. And how do you show or let people know that you're not crazy, you're not like some whacked out guy who just wants to make the world better but doesn't take reality into consideration? That's a real art. But if you do it well, like here in DC, where almost every neighborhood in DC, underserved neighborhood, gentrified, because we're affluent, we're an exception, like San Francisco and other cities. So how do you convince someone to come into a neighborhood where you're literally maybe not comfortable even driving through? And that's a challenge. And again, it's a narrative that you need to create that's based in reality, but also based on a lot of other information that's not typical of a typical real estate investment, for example.
Right. So part of what we're talking about is one going to a different group of investors. So not your classical real estate investors, not the people who want to buy low, sell high,
Mhm.
but do something that will make a reasonable profit while benefiting the people who are already in the community. So, one of the greater problems of gentrification is that people come in from outside, they make their investment, and when they make their profits, that money leaves the neighborhood, which makes it, in some ways, even poorer than it was before they did their deal. And this kind of underscores the problem or amplifies the problem where people go, I can't afford to live here any longer. I can't afford to buy groceries in this neighborhood. I can't afford any of these things. And this causes, in some ways, an interesting thing because property values may go down in some ways as people have to escape to a place where they can afford something, which just attracts more people to come in and buy stuff low and build high rise expensive units and so forth. So, who are we talking about now when we're talking about shifting away from a more classical real estate investor to someone who might have an interest in investing in a community?
Well, there are several opportunities out there or options out there that don't even know that they're likely prospects for this. And but it's again not conventional, not straightforward like a regular real estate deal. So the question is, who can you bring together that has the resources? Or in many cases, like some of the projects we're looking at, you really need to aggregate various sources. You need to bring in the foundation that can help with the pre-development money to lower risk to get things going. You need to attract donor advised funds that want to do well in the communities, but maybe don't have the right relationships in the communities. You want to reach out to investors that have a clue, but they're okay with a little bit below market returns or patient. So the idea and the trick is, and which makes our kind of niche a little more difficult, is how do you assemble all this? And that's where experience, reputation, credibility, authenticity. How do you know what's going on in that community? Well, some of us live and work in these communities. Some of us are active in these communities. Some of us really understand that the traffic and all these other economic circumstances make this funky little neighborhood now eventually very desirable. And remember, every gentrified community ultimately was a community that was not considered an attractive community. So, how do you bring the right people together who are comfortable doing things a little bit differently without necessarily giving up return, uh, good returns?
So, so we're talking about going to a different group of investors who have different reasons, different motivations
Mhm,
to invest, and soft sell motivated money.
mhm,
And the point being that a real estate investor who comes in to do a fix and flip or a build and flip really isn't investing in the community. They're here today, gone tomorrow. They're making money. Can't fault them for doing that, but it has a negative impact on a lot of these communities. And so we're saying, well, if we want to do something that benefits community, we're going to have to go to a different investor. And you've mentioned a number of these different people who may have a reason to invest. It may be part of their mission, it may be part of their personal goals. And at the same time, we have to tell a story, though, that makes them comfortable. One, we are talking about getting a profit, we are talking about creating a rate of return, but we're going to have to tell them more about why it's okay to work with this particular community so that this isn't a crazy scheme of some kind or wishful thinking, which is another way of saying it's a crazy scheme.
mhm, mhm. Exactly. And, again, the idea here is if we're not making profit, we won't be around long. So no matter how idealistic some people are, and I'm idealistic, I want to change communities, but I also recognize that rebuilding the underserved communities are called the slums, the ghetto, in the inner city, whatever the term is over the decades. It's a very lucrative business if you get in on time, if you're comfortable with the community, if the community is comfortable with you. I'd have investors who had all the money in the world, and they'd come to me. It's like, how do you find these deals in neighborhoods that were changing in DC? And I'd say, well, I live and work here. And when people began to realize I keep coming into a community and I'm not going anywhere, I'm not buying stuff on the corner, I would get access to all sorts of opportunities that would never reach the market. So in this case, I was able to identify deals that made sense because they weren't on the market, and I would be able to find these things. And that's how investors were attracted to working with me, even though they never thought in their right minds they'd be investing in less desirable communities in DC. And it's just not the business real estate; it's also businesses. If we're buying a building and we're renovating it, and we want businesses to do well in our community, in our buildings, it serves us well to work with businesses who could literally help be successful, or even become part owners of maybe they're part of the building. And that's how you build a real network that just reinforces everyone's ultimate returns, mitigates risk, and then attracts attention from other sectors, like other businesses that want to come into the community, because now you've established that you can open up that coffee shop and do well. Or housing is starting to take off in your community, but it's not being too priced out. Although in DC, we're gentrified out. So now we're going up to Baltimore, where the prices are much better, and of course the need is there. So again, the idea is to attract these kinds of investors. It's not usually one investor will come in like a conventional investor. You need to bring in a coalition, which then again reinforces and mitigates risk, allows you to get into these projects, these opportunities before the rest of the market catches up and then stabilizes your ultimate investment.
So I'm hearing two things. One is you need to have local knowledge, and local knowledge may only be gained technically by being local, being part of the community. And to some degree, when you say you're being local, you have to manifest or you have to demonstrate that by showing that you are here for the community, not for yourself only. You're not in and out kind of a person, which probably opens the door to more information about opportunities, but it also changes how you look to the community and you look to outside investors, because the investors are going, we're not investing in somebody who's going to pop in and out of the community. We're actually now investing in a person who's in the community, who's with the community. And so this changes the story, changes the perspective to the investor, that this group of investors, and I'll say it, this group of different investors, to be really clear, because one of the things that is easy to realize is that you may not be able to raise all the money you need within the community that you're trying to serve. And it's necessary to bring in outside funding, which may be the majority of the money needed to get everything started, and then work towards self-sufficiency, sustainability. So as you're trying to tell this story to the different groups, you've told them now you're going to go someplace they wouldn't want to drive through, and that the property is all distressed and so forth. And this sounds like the beginning of a really bad story. So how do you change the ending to make it more attractive to somebody?
A lot of work and a lot of sectors that you need to bring together. You go in these communities and you can tell which businesses has become the anchor that really then resonates, and then it then becomes more realistic for other businesses to come in, which really helps the fabric. The other thing is, and I stumbled across this, is the importance of community arts is an incredible component to tie all this together. So I grew up, arts. Who wants arts? But I accidentally got involved in an initiative with a dance school that wanted to rent some space that I had rented out to encourage some artists on the main street of a neighborhood I was investing in. And then, long story short, I realized, wait a minute, we can put artists will go anywhere it's cheap. And wherever artists go, when they're done, they want to go out and get a coffee or this and that and the other. And the more funky your neighborhood is, the more it becomes like cool and hipster. And then all of a sudden you realize, wait a minute, this arts group is starting to take off, and it's helping impact other economic activities. So the politician who recognized what we were doing came in and started supporting us and giving grants, helping with grants, got the economic development community involved. So all of a sudden, the pieces were coming together. It didn't happen overnight, but it became viable that this funky little town on the border of DC, for example, which where I live, had some real potential and possibilities. And then they came together. More little small businesses started coming here, all funky, cheap, and pretty appropriate for the neighborhood. And then all of a sudden, the artists started buying the housing, or a little better off the artists. And that's how it all came together. But you need to really put it all together. And once you get a certain part, then the market starts opening up and it becomes less of a chore to attract investors. But then you get investors then that want to, come in and, make as much money as possible, which again is the conventional way.
Well, yeah. So as I hear you describe that, now it sounds like we have a distressed community where we're going to give stuff away, and we're digging a deeper hole for ourselves in terms of an investment standpoint. But what I also hear, though, is that a lot of these communities have become victimized, for lack of a better description, where they're not thinking of themselves any longer as a community. They're just a bunch of individuals who happen to live in close proximity to each other. And when you do a art project, it comes across as something that they can benefit from, they can participate in. In effect, arts are for everybody, which may be a phrase we have to use more often going forward. But now, instead of being a project where somebody came in and bought a square block and they're going to put up a high rise and they're never going to participate, they're never going to have a part or ownership in that. If you do a community oriented project like the arts, everybody goes, well, I get something from that. I get some benefit from that. So that's something they can rally around and start working towards identification as a community again, which is often lost in a lot of these communities I talk to, where the neighbor doesn't know their neighbor. They have nothing in common except they're surviving.
Mm-hmm. Yeah, that's another part too. Is one of the things I began to look for as I got more experiences, which neighborhoods are actually looking out for each other. The old broken window concept of, if you see a lot of broken windows in the community, that means that neighbors don't care about each other. So the first thing I would do is literally walk through, roam around some of these communities, and I'd kind of read the reaction I get. Well, first of all, a white guy walking some of these communities gets some strange a caution reaction, because white guys in the hood are never, are not always welcome. That's for good reasons. But my point here is, when you can find an area that has the underpinnings to be able to build a healthier neighborhood, not completely blow it out with high rise, inappropriate development, but slowly build it up. That to me is where I've been very successful in helping create stronger communities, meaning better lower risk kind of investments, when you can really read what's going on, which communities can come together that ultimately will protect your investment if they're coming together, organizing, or demanding more political input or resources. And that's exactly what's happened in the neighborhoods that I've been involved with. And it's very unusual to have a real estate developer investor approach this way. It's very unusual. And it took about 10 years of my career for people to stop being skeptical when I'd say, I'm a for-profit developer with a nonprofit agenda. People are like, are you kidding? And by the way, most skeptical, like, what? There's what? But it took about 10 years to show that, people before profit was more than a slogan. For me, people before profit was a moral imperative, but also I realized It was a great opportunity because I was getting opportunities well below market, which meant that even if the area is gentrifying, I still had good projects or good price points that no one else had. So I was able to take a little bit more of a risk, but also knowing that the community was going to eventually uh, improve uh, my investment. That's tough to do as an armchair real estate developer from a real estate office from downtown.
Yeah, no, and there lies another element to the story is that there is a recognition that some communities are too far in the hole. They may not be retrievable or savable. And your skill in working with many communities over time, this is basically a body of experience that is part of the overall evaluation of the community that investors can look to and say, he's been there, done that. He understands that the broken window test, or I have other tests that I use when I look at economic development programs, where I struggle with what I call wishful thinking, where people go, well, when the government gives me a check for this, then we're going to go do that. And I go, well, what's the due date on that money showing up? And is it going to cover the entire cost of the project, or is it only going to cover like a quarter? I go through this analysis, and they're looking at me like, well, why would you ask those questions? I said, because if you don't have all the money you need, it's never going to happen. And if you should, for whatever bad reason, get started
Yeah.
and find out you don't have enough money, then you have what we call an incomplete project.
And
So,
plus, all the cost of putting all that together to apply and hope you get the funds and all that stuff. And even when you do get the funds, I don't know why this is, but the check is always in the mail for months. So even if you have, and real estate investors out there, that if your development project is slightly off schedule or too many outside factors, then you are already in trouble. I remember I getting a call from a major nonprofit in DC who I was working with to sell the units I was developing. And he called and said, I heard a rumor that you're paying 24% interest for your money. I said, that's not a rumor. That's true. And he just like, what? I said, George, with 24% interest, I was able to get 110% financing. I was able to make a very aggressive offer on a block that no one wanted to touch because it was really a drug infested block. And I'd already been organizing, knowing that we can get rid of the drugs and all that stuff because dealers don't want to be in an open market when the neighborhood, their block is changing. And more importantly, I said, George, on your projects, great nonprofit developer in DC, why does it take you 2 or 3 years before you can even break ground, even after you get commitments? I said, in 60 days, I closed, clear title. We're doing our thing. So I'll pay 24%, not happily, being able to control the project, lower the price. And plus, by the way, I didn't need developers. He quietly apologized for, he was upset. Why were you paying 24%? Because if I wanted the government who would be finding some ideas, even when I got approved, I never got money except one time I was approved. And it's like, well, when's the money coming? So that's a real problem. The other big thing that's really
let's stop there, Steve, because you're making a very important point. And I have some projects just like you described, which are stuck in nowhere, and I don't know if we're ever going to get them unstuck. It's one thing to pay 24% interest for 6 months or a year. It's another thing to pay 24% for 6, 7, 8, 9 years, which may make the whole project unworkable. And yet this is a very common challenge for real estate developers, is because in the very front end of a development cycle, which we call pre-development,
yeah.
you may get caught up with a government permit, a zoning issue, a mad neighbor, somebody who's got more political clout than you decides this is not in their interest, so they're going to interfere with the entire process. And if you're paying 6, 7, 8, 10, 12% interest over 6, 7, 8, 9 years instead of over a couple of years, it's not a very good model. So the again, the knowledge about selecting communities, how to work with the local people, how to fund a deal to accelerate it through the redevelopment process. These are all making this deal look much more viable than something that's attempted by somebody who is working from outside, doesn't know what they're doing, doesn't care about the community. They're only there to make a buck. And again, this is not talking negatively about people who are making money by investing in real estate. It's simply saying that this may not be the right opportunity for them to get involved in.
Without a doubt. And you're absolutely right. I went after this money because one, the funder knew that if there's any developer that could turn this around, it was me. And of course, anything more than a year or two of this kind of money, yeah, that would have been really, really tough. But we did our projections and we realized, okay, we can get in there and out. And then this particular investor, he did so well in the first round. Let's buy up the rest of the block, and which is what we started doing. And it took me a few years, and I was able to finally attract an investor who was very, very interested in. Well, he actually bought part of the company and replaced that very expensive money with. So, unfortunately, it was 1 year to the day before Lehman Brothers crashed. So, so it was a great partnership for about a year or two, and we hung on, and well, the rest is history. But I'd also like to talk about some of the major kind of funding tools that have come up throughout the years. You've heard about impact funding. You've heard about the crowdfunding. So, Karl, maybe we should talk a little bit about some of those, major changes, relatively new changes that we're also going to be tapping into.
Yeah, and that's where I think it's important to note that the regular real estate investor who's looking for a maximum return, buy low, sell high, in and out, short term, as much as they can make it in a project, is not who we see as the definitive highest priority investor for doing community investment. We're talking about a lot of different sources. We're talking about a number of new tools in the toolbox for making the funding. And we started off, Steve, you mentioned foundations as one possible source of money where the redevelopment of a community is within their wheelhouse. This is something that's in their mission, what they're trying to accomplish. And so therefore they are a potential source of money. And in the past, I'll say it's technically it's an ongoing transition, but in the past, that primarily they make a grant, which is a one-time giveaway of money. They get nothing back other than a good feeling in their hearts for having helped us along. But there's a new thing, or I will say it's an evolving thing. It's been around for a long time called a program-related investment, where a foundation is allowed to make a investment in a private company or project. They're allowed to make a profit on that. And the IRS has signed off and actually endorsed this better use of their funding. And yet this is something that's still relatively new to the foundational communities. There's all kinds of programs going on trying to help them understand, learn, and adopt this way of moving money. And the simple response to the foundation is if you give a grant, you get nothing back. If you give a loan for pre-development cost and you charge a 1% interest rate, you're actually making 101% more money than you would have made if you made a grant. And some people have had to turn their minds inside out to suddenly recognize that, this means that the foundation is replenishing its money so that it can do more good things. And so it's one new tool in the toolbox for us to look at.
Yeah. Well, let's start off with that's a good one. And there's a couple other major things that have been happening, but very slow. I approached foundations years ago. I said, foundations, you keep giving your money away. Why don't you invest and become catalysts? Particularly the pre-development and the upfront kind of monies, it would have such a huge impact. At the time, they said, "Oh yeah, we were some foundations were like, yeah, we're exploring that." That was like 15 years ago. The fortunate thing is, the concept which they were embraced. Foundations are some of the slowest innovators out there, but they're finally beginning to realize, and there are some foundations, I won't mention any, but we're starting to approach them, and we have some relationships to connect with them. They are interested in actually investing. So as Karl said, they invest, $100,000 to get something going, and they get back $101,000. That's 101% return based on what they're used to. So foundations are becoming a little more interested in this, and they would be a major contributor to that kind of gap or hard to find money, especially up front where there is risk. Pre-development, you could do your pre-development, spend money, and realize, no, this project doesn't make sense. Well, that money's gone. Conventional real estate people, that's just the cost of doing business. So the question then is, where are these foundations? What can we do to get them to mobilize this money? And what do they need to do to mobilize? And the other part of the problem there is that a lot of these foundations just don't have the right advice deep in the community. You can't go to a real estate advisor who's never really worked in these communities and say, foundation, where's the best use of our funds? You have to work with developers and or investors that know what they're doing in the community, have the trust of the community, and say, these are projects that are worthy of investment. Now, foundations, you need to be a part to come in here. That part, I think, over the last few years is finally starting to take hold. And that's where the RCI community funds that Karl, I, and other investors are putting together, that will be one of the ingredients of the aggregated sources of funds that we're working on, because you need a collection of these funding sources. On the other hand, they see us as someone who's got tremendous credibility, community relationships, political and activist, connections. In other words, we're part of the community. And our approach is just not real estate. It's also, what can we do to reinforce return on our real estate, which is businesses that use our space, healthy businesses, and residents that we, will be good, strong, tenants or co-op owners. We're looking at all sorts of real estate ventures. So foundations is one alternative. Karl, you want to mention another one
Yeah.
where we recommend?
Well, no, I was just going to point out that part of the design that we're using is that if we, through a fund, invest in a local business, then we want that business to put their workers into the residential property that is being invested. We want them to lease space and both in a rent to own, lease to own thing. So we're building wealth in the community, but that serves to fill up the building. I'm still challenged when I see a real estate developer going, I'm going to put a building right here. And my next question is, well, that's a building. It's not generating any income until you have tenants. Where are your tenants coming from? And they'll show up. They'll just happen, and you're like, well, okay, now you're getting into wishful thinking and speculative thinking, where we're trying to do something that benefits the businesses in the community by providing residences for their workers, for providing them with commercial space, but we're tying them together. So we're talking about occupied buildings, not just buildings when we talk real estate. And to me, that's a little bit of maybe a major different story than what other people are doing. But yeah, there's other tools in the toolbox here. I'm thinking that investment crowdfunding is probably the newest and biggest tool in the toolbox, because it allows us to do things that you couldn't do before.
Yeah, I was really excited when I started reading, I don't know, about 15, 20 years ago, this concept that was brewing about. And when it finally became legislated in I guess about 10 years ago, 2016, the Jobs Act was approved. So crowdfunding became a concept. I thought, wow, what a great idea. Local community or anyone can invest small amounts, pull it together, and invest in the local community. Thought it was great, and it is great, and it's, I think, a great potential. But at the end of the day, it's still a very small sector of the investment pool, partly because a lot of people have no idea that they can invest $100 or 1,000 or 10,000 in projects that meet their principles or their convictions that give them a return versus just a donation to a nonprofit. So crowdfunding is another great tool that I think is in its infancy, And just broadly speaking, once the bigger audience becomes more aware that instead of keeping money in your mutual funds that are investing in the prison industrial complex or other things you may not like, that there's a way to actually move your money to investments in the local community, yours or other communities. This is an emphasis of what RCI Community Funds is doing, is let's invest in other communities, and then let's invest in your community as well. But the idea is, how do we build a bigger audience to let them know that there is a viable investment? You may not get the returns that you would if you go into high speculative kind of or stock market investments. But these are solid, well thought out kind of small businesses or real estate opportunities that is definitely demand, because if there's not enough housing, there's the housing is a good investment. So crowdfunding
Well,
is a good new tool that is growing.
yeah, and here's why I think it's so dramatic in its potential is that before we had a community underserved, economically distressed. We're using the term disinvested because the other labels seem to like lay part of the blame on the people in the community. And we're trying to be very clear that we don't think that the people in the community are the problem. They just happen to be in the wrong place at the wrong time, and the money went somewhere else. The thing is, with crowdfunding, it's now possible for a member of the community to actually invest in their community. They can make a small dollar investment in a piece of property or in a business that's in the community, where before they either legally could not at all, or practically no one gave them a chance. I remember people go, well, yeah, a non-accredited investor, which makes up 97% of the current US population, they could always invest in something. I go, yeah, they could, but the deals that were on the table would start with a minimum investment of $25,000 or $50,000, which if you're taking home only $50,000, that's not going to be too workable for you. Now we've got the potential to break down these investments into small dollar amounts where everyone can afford to make an investment. And that includes the people who live in the community where you want the investment to occur. And so they can start building wealth both individually and collectively. And then this opens it up to everybody outside of the community who wants to chip in. So why, Steve, would anyone who lives in San Francisco want to invest in West Baltimore? What would drive them to do that?
Well, if you invest in stocks, where are the businesses that are taking your money and deploying it? So this is a way, if it's not literally local to you to invest in, it's still a local activity. Localism is an environment, is an economic movement that, whether we like it or not, is happening, because we have to rebuild our communities, the environment, the international trade, all that. It really comes down to localism. So I think, again, wherever you invest, it's usually not right in your community. The crowdfunding is a way to allow you to invest in your convictions and to support things that you want to see happen, like small businesses, get capital that maybe is not as rigid as other sources, but help them get going. That then again, helps the entire community, the common good.
Well, but I think that part of what we're seeing here as we try to tell the story is that it's good for us to draw analogies to other types of things people are already doing. We say, well, why would you invest in a distressed community? You go, why do you think real estate developers invest in a distressed community? Because the property is cheap and they see it going up in value. Why would you invest in a local community that's not in your backyard? Well, you do it all the time through a mutual fund or any other. I mean, the likelihood that you've invested in local business is almost zero this time, statistically, even though you now have the opportunity to invest. A lot of the small businesses, one, aren't offering any kind of local investment because they don't know, and they're all looking to banks as their primary or only source of capital. And at the same time, people don't know that they have the opportunity to invest because there's no communication channel. I often make the joke that um, people looking to do crowdfunding investment don't get up in the morning and flip through the Wall Street Journal. One, because they don't get it, and two, the Wall Street Journal doesn't carry small dollar investment information. They're only carrying the stocks that are traded on the stock exchanges. We're starting to see for the first time actually communication channels that like Supercrowd and some of these other groups are starting to publish these information on these small dollar investment opportunities. So you can get up in the morning and flip through your computer to find some investment opportunities. But it isn't something that people commonly do, particularly when they're double shifting just to keep the lights on.
Yeah, chances of you finding an appropriate business or an opportunity within your own community is very easy to find. Go look at all sorts of crowdfunding platforms. You'll find something literally in your neighborhood. Our role, though, is much more national, but again, the same principles apply. We want to improve local communities. So if you're investing in Baltimore, even though you might live in Los Angeles, that's fine, because chances are, if you see that you're the benefit of what you're doing in Baltimore, then you'd probably be more inclined to get more involved in your own community.
Yeah, so we've got now crowdfunding, we have foundational investments. You mentioned donor advised funds. Share a little bit of information on what that is and how that might help out here.
Well, you're probably a little more well versed in DAFs. So donor advised funds are funds that, frankly, well-off people will move into a foundation, or not a foundation, but I guess a foundation, who then is tasked to take their funds and invest in things that particular donor wants to see invested in. So they are, and this money is designed to help invest in areas that they have convictions in, whether it's environment or economic development. The funds they get a tax benefit from it, but they don't share in the actual investment itself. It's a more flexible way of getting funds, kind of aligned with foundations. There's some pretty big donor advised funds that are out there, but again, they need help finding appropriate projects, worthy projects that meet their agenda in the community. So that's another benefit working with us, is not just us, but our networks. We want to help make sure that if they're interested in affordable housing in healthier communities, then we would help direct that money there. There is a lot of money and a lot of interest, again, more so now than say 10, 15 years ago, because everyone's beginning to realize, it's like they just woke up from the pandemic, that investing in underserved communities really serves the common good. It benefits in so many ways, lowers taxes, safety, all sorts of things, creates opportunity. Aside from, again, the moral imperative of creating less poverty. So that's a vehicle that is a powerhouse that's still trying to, create these mechanisms to get funds to deep into the community.
Yeah, so telling the story, we now have several audiences. So by definition, we have to tailor our story to each of these audiences in order to have them hear us, understand us, and positively react. So one of the things in working with a community investment project is the ability to combine all these things that we've been talking about. Yeah, it is a real estate investment, but it's also local business investment. Yes, it's something that's been done. It's being done all the time. We're just maybe a little bit ahead of some of the other people in a particular community, and we're not there to come in and go away. We're there to help the community go forward. So different pitch to different audience. And at the same time, we have to layer it with information so they understand not only the mission and the outcome we're looking to achieve, but the mechanism by which they can put the money to work. So when you talk to a foundation, you're going to talk about program-led investments. When you talk to an individual, it's crowdfunding. Donor advised fund, it's a street level project where they need to share the information back with their donors because they're making charitable contributions into the donor advised fund, but they're directed. This is a term used with donor advised funds, which means the person who made the donation can pretty much tell them, put the money here or put the money there. Well, if these people making the donations don't know about this, then they may not tell them to put it into a specific project. They may just say, put it somewhere wherever you think will work well. And we're back again to people who are controlling the money, not understanding where and how they can put the money to get the greatest impact. So it seems that we're both telling a different story to different audiences who often are not aware of the opportunity that's presented. So we have an awareness issue, then we have a storytelling issue, and we're telling it to different types of investors as we would define them. So it's starting to sound pretty hard.
Well, exactly. So, as I said in the beginning of the conversation, if it's a regular real estate deal, the pro formas and what an investor wants to look at, it's easy peasy. This, though, is, as you said, different pools, different stories, relatively the same, but different angles. DAF funding is probably a little more interested in, do you know what you're doing business-wise? Does this make sense? Foundations are, how many people will benefit from this? And other sources are going to ask their own questions. So you take this story and explain, justify to that particular audience. So yeah, it's not a one size fits all kind of thing. We have to kind of adjust it with the hope that 4 or 5 of these sources come together and realize, oh, this is very nicely a good collaborative process, and maybe we should all jump in here and do this, which is great because we want to create scale. We want to be able to do this not just one off, but literally show that there is a mechanism. It makes economic sense. And it benefits everyone because, again, economic growth, stability, all helps everyone, lowers taxes.
Right. And this sounds like yet another challenge, but people are now, we're talking to them about something more than ROI, return on investment, which is a pure monetary form of metric. We're talking about things that people care about, but are harder to measure, harder to qualify, like new businesses, jobs, number of new residences being built. So we're building a social impact metric scorecard or something that we're still trying to label, where we can say we're going to measure all these other things that come from a good economic development project, that come from revitalizing a community, so that people who want to make an investment decision have more to look at other than an ROI statement. What are the things that you think people are most interested in that they would like to see when they consider an investment in a community?
Well, again, I've been around a long time. I've learned a lot about the human nature. And I found early on that when I attract investors who saw money in what I was doing, and then they got to know me, and then we did some work together, then I began to realize some of these investors were really feeling good that what they were doing was actually not only making them money, but doing something. And they started taking ownership of my impact in the community. And to me, it's like, that's odd. Didn't it ever occur to you that, helping people or, makes you feel good? Or some people just don't have that. So, some of these investors will take a little less knowing that they've done something. Or recently, we've been talking to some really very successful, ended their career. They made literally quite a bit of money. And now we're talking with one group, for example, he wants to take $200 million and invest in affordable housing. Now, he doesn't know where and how. And the question is like, okay, what do you want for that? And he wants just like a very nominal return because he's made all the money he can ever spend. And he wants to take on $200 million. Now, the problem for us is, do we know any $200 million projects? No, but we might have like $50 million. Anyway, So again, it's the rationale is because, like, why would you want to do this? Is because he wants to get a return because he's always used to it. But is he going to stay up late at night, worrying about? I mean, this guy's a billionaire, a multi-billionaire, and so he has his motivation is a little bit different. End of life, he wants to give back. So the idea is, where are those folks at? They're out there, and when they turn around and say, "I want to do something good for the community," or make a little bit of money, or no money, give me 0%, knowing that I'll get my principal back. That area is that sector's growing, but they have very little connection to where and who to connect to. They call their stockbroker or their real estate advisors. They don't have that kind of outlet. Oh yeah, you should talk to these guys. They're literally smack dab in there, and they're not stupid, or they're not.
Yeah, no, but I think this is closing the gap that we're talking about, bringing resources to a community, matching them up with a community. And one of the greatest challenges there, people go, I don't live there. I'm not part of that. I don't know how to invest. I don't know why to invest. I have no pathway in front of me that's well trod that I can go down to do this. So it's
Yeah,
a little bit of an adventure for people. We were talking with Devin Thorpe with Supercrowd last week, and he was pointing out how people who invested in a small business suddenly become more aware of what it means to be a small business and how that small business works and so forth. And it suddenly they had a greater appreciation for the people who are running the businesses and the difficulties that they face on a day-to-day basis. And I think we're going to see the same thing here on a larger scale when we talk about getting into disinvested communities where people go, yeah, I know they're there and it's really sad. And you're going, okay, let's take a little action here. Let's move beyond feeling bad about it
yeah,
to let's do something positive. And their response is how? It isn't that they don't want to, it's just that there's no mechanism in place. And I see this as going to be one of the biggest things on how do you communicate to people who have absolutely no familiarity, no background, no basis, that they
yeah.
can do this and do it in a regular, methodical fashion.
The mechanism is not in place, but it's beginning to figure itself out. So we're looking to find folks that have resources that want to bring into the community. They're looking for us. So it's still taking too long, but how do we start connecting it? The other side of the equation is, all right, let's put capital together. Then the question is, where are the real opportunities? So that's the other part of the equation. And again, most underserved communities have the same kind of issues: housing, the job, business development, all that stuff. So relatively speaking, that part is not a problem, but you still have to find the most likely. So that again is part of our repertoire. We're not just investors. We want to be very wise investors, and being connected and having knowledge of communities is very important to mitigate everyone's risk. Because again, if you don't have a positive with your resources, you're not going to make progress. So we're close to the end of the hour. So Karl, we talked about several alternatives, including a few others we didn't quite get to. The first one, of course, was foundation money. That's getting a little more social entrepreneurial. We got donor advised funds. We have crowdfunding, which is small but has tremendous potential. We didn't really talk about private investors that want to just invest because they've made enough money and they're okay with their net worth. They want to give back a little bit and take patient money. Another area is the community development, CDFIs, community development investment.
Yeah.
Those are kind of in between a real bank and private funding. Still go through a process, but they're much more liberal. So that's a major growing area that's we can tap into. So those are just a handful of some of the alternatives. The key is they need to find out that there are really good opportunities out there, and there are also mechanisms or collaborations like us that are looking to tie these things together. So RCI community funds, that's part of the purpose. I'm very optimistic. For the first time in literally decades in this business, I think there's some institutional uh, progress and putting these things together so that we can build instead of just go through this very slow process of trying to invest some funds in that may not be as productive as we'd like if we had streamlined processes.
There are so many other participants, possible partners or allies. People are trying to reach the same outcome, but take a different way of going about it. And this all contributes to part of the chaos of trying to sort through this, creating an investment opportunity for people who may not think of this as an investment opportunity, and doing it in a way where they feel good about their investment because it goes beyond ROI to impact, whether it's a private investor or it's just an individual who is rethinking where's their money working for them today. Is it working on Wall Street or is it working in a local community? Where do they feel better about that choice? So many different things to come together, but it does seem that everything's trending in the right direction to accelerate that, to help people take action quicker by giving them a clear story for them that they can understand, and they can be part of the story by becoming investors. So, very interesting situation. Appreciate, Steve, you being on the program this morning, talking about investing in communities and the different reasons and mechanisms for making that happen. I'm sure we're going to come back again later, but if you don't get enough of this, the RCI Community Funds has their own show now on Thursday mornings at 10 o'clock Eastern Time. And all they talk about is community investment and the different things that they're going through. So invite you to join the audience on LinkedIn Live on Thursdays. And then from my perspective, I commonly write about different aspects of investing that affect or impact communities. So you can check in on this show every Tuesday morning, or you can look to my instant funding newsletter that I publish on LinkedIn. So I invite you to consider doing that. And with that, the day after Labor Day, we didn't have anybody chip in from the audience, and I have a variety of questions on why that didn't happen, but that's all part of the deal. So, Steve, thanks for being my guest this morning, and we'll have you back on the show